Welcome to Money Mindset. In this video, we're delving into a strategy that holds immense value for both newcomers and seasoned investors. It's called dollar cost averaging, and trust me, by the end of this video, you'll have a solid understanding of how this strategy works and why it's a game changer. What is dollar cost averaging? Imagine a scenario where you want to invest in the stock market, but you're unsure about the best time to jump in. This is where dollar cost averaging comes to the rescue. Dollar cost averaging is an investment technique where you consistently invest a fixed amount of money into an asset, regardless of its price at the time. This means you're buying more shares when prices are low and fewer shares when prices are high. Over time, this strategy helps smooth out the volatility of the market, potentially reducing the risks associated with trying to time the market perfectly. The pros of dollar cost averaging. Let's take a look at why dollar cost averaging is such a fantastic strategy for building your wealth. Minimizes emotional decision making. Trying to time the market often leads to emotional decisions influenced by fear and greed. Dollar cost averaging eliminates the pressure of finding the perfect entry point, making your investment journey a lot more stress-free. Consistent investing. With dollar cost averaging, you're committing to investing a fixed amount at regular intervals. This consistent approach encourages disciplined saving and investing habits, ensuring you stay on track toward your financial goals. Benefiting from market volatility. Market prices go up and down, that's a fact. Dollar cost averaging allows you to buy more shares when prices are low, effectively capitalizing on market dips. Over time, this can lead to a lower average cost per share. Time in the market, not timing the market. The golden rule of investing. It's virtually impossible to consistently predict market movements. Dollar cost averaging allows you to be invested throughout market cycles, giving your investments more time to potentially grow. Reduced risk of overpaying. Let's face it, nobody wants to buy an asset at its peak price. Dollar cost averaging eliminates the worry of overpaying, as you're buying at various price points over time. More on time in the market, beats timing the market. You've probably heard the saying, it's not about timing the market, but time in the market. Well, that couldn't be truer, and dollar cost averaging embodies this philosophy perfectly. Imagine two investors, Jane and Mike. Jane tries to time the market, waiting for the perfect moment to invest. On the other hand, Mike practices dollar cost averaging, consistently investing the same amount at regular intervals. Over time, Mike's investment experiences less volatility and potentially higher returns compared to Jane's erratic approach. So there you have it, fellow financial enthusiasts. Dollar cost averaging is your secret weapon for navigating the unpredictable waters of the investment world. By staying consistent, minimizing emotional decisions, and benefiting from market volatility, you're setting yourself up for a more secure financial future. Remember, it's not about predicting the market's next move, but rather giving your investments the gift of time. If you found this video helpful, don't forget to hit that like button, share it with your fellow investors, and subscribe for more financial insights. Until next time, happy investing.